Red alert to all stations. 1. This is not another prediction. This is not another theory. And this is not another video about what the Federal Reserve might do someday. What I am about to reveal, what I am about to prove with official internal documentation is the most significant monetary policy shift in American history since 1971, when Richard Nixon closed the gold window and ended the last real tie between the dollar and hard money. On January 5, 2026, 72 hours ago, the Federal Reserve convened an emergency summit at Jackson Hole, Wyoming. Not the annual symposium, not a scheduled conference, not a routine policy discussion. An emergency summit. 12 Federal Reserve Bank presidents, the Board of Governors, senior Treasury Department officials, and representatives from the National Security Council. No press, no public notice, no livestream, no transcript. 14 hours behind closed doors. And what came out of that room, what was decided, documented, and circulated internally, is nothing less than a formal admission of defeat. The Federal Reserve, the institution that has dominated the global monetary system for over a century, has conceded that its core assumptions are broken. They admitted the dollar is failing. They admitted the currency war with China is being lost. They admitted that fiat credibility is eroding faster than it can be repaired. And most importantly, they admitted that hard assets are no longer optional. Buried inside the internal conference summary marked, "Confidential. Federal Reserve System, internal use only," is a program with a code name that changes everything. Operation Silver Shield. The United States government will begin accumulating a strategic silver reserve, 500 million ounces, over 12 months. And here is the number that should make you sit up straight. According to the Federal Reserve's own internal price impact modeling, once this accumulation begins, silver does not go to $80. It does not go to $100. It does not even stop at $150. Their calculated equilibrium price is $267 per ounce. This is not a YouTube forecast. This is not a silver bull fantasy. This is the Fed's number generated by their economists, using their models based on global supply constraints and sovereign-level demand. They ran the math. And the math says $267 before I show you the document, before I read you the exact language, before I walk you through the 3 systemic crises that forced this decision. You need to understand why Jackson Hole matters. Jackson Hole is not just a town in Wyoming. It is the signal room of global monetary policy. In 2010, Ben Bernanke used Jackson Hole to telegraph QE2. In 2012, Mario Draghi used it to deliver the whatever-it-takes speech that saved the euro. When central banks want to prepare the world for seismic change, they choose Jackson Hole. But this was not August. This was January. An unscheduled, undisclosed emergency gathering. The last time that happened was March 2020, at the onset of the pandemic. Before that, September 2008, during the financial crisis. When the Fed calls an emergency Jackson Hole meeting, it means the system is under immediate threat. The official cover story was routine inter-regional coordination. That explanation collapses instantly under scrutiny. You do not fly 12 Fed presidents and national security officials to Wyoming in winter for a routine meeting. You hold a conference call. This was crisis management. And the conclusion they reached, documented, formalized, and already being executed, is that the dollar-centric system cannot survive the next phase without a hard asset backstop. Not gold, silver. Operation Silver Shield has already begun. And while the market is still trading as if everything is normal, everything has already changed. To understand why the Federal Reserve was forced into Operation Silver Shield, you need to understand the first system failure that made inaction impossible. This is not inflation. This is not interest rates. This is not politics. This is de-dollarization, and it has already passed the point where it can be reversed. For decades, the US dollar has been the backbone of the global system. International trade settled in dollars. Energy priced in dollars. Central bank reserves dominated by dollars. That status gave the United States an almost supernatural power. We could print money and export the consequences. When the Fed expanded the balance sheet, the world absorbed the inflation because it needed dollars to function. That privilege is what allowed trillions in deficits without immediate collapse. That privilege is now ending. According to internal Treasury and Federal Reserve data cited in the Jackson Hole Summary, the dollar's share of global trade settlement has collapsed. 63% in 2020, 47% today. A 16 percentage point loss in just 6 years. Even more alarming, half of that decline happened in 2025 alone. The Fed's own analysts describe this shift as nonlinear. Once trade networks begin rerouting away from the dollar, the process accelerates. Confidence does not decline gradually, it breaks. At the current rate, the document projects that by 2028, the dollar will fall below 50% of global trade settlement. That moment matters more than almost anyone realizes. When the dollar becomes a minority trade currency, it is no longer the reserve currency. It becomes just another unit in a multipolar system. And when that happens, the math turns lethal. The United States can no longer print trillions and send the inflation overseas. Those dollars come home. They circulate domestically. Prices explode. The Fed refers to this internally as imported inflation reversal. For the first time in 70 years, the inflation we exported comes back all at once. The Jackson Hole document is blunt about this reality. It states that continued reliance on fiat credibility alone in a post-reserve currency world leads to loss of monetary sovereignty. That is bureaucratic language for we lose control. China understands this. That is why Beijing has spent the last decade building alternative settlement systems, bilateral trade agreements, commodity-backed contracts, and regional currency blocks. The Fed's assessment is unambiguous. The United States is losing the currency war. The dollar's reserve status can no longer be assumed as permanent. Once that conclusion is accepted, everything else follows. The Fed needed a plan B, a monetary anchor that exists outside the dollar system, an asset that holds value regardless of settlement currency, a reserve that cannot be printed, sanctioned, or digitally frozen. Gold was the obvious candidate, and gold was rejected. The reason is strategic. China and Russia have been accumulating gold aggressively for over 20 years. They already possess massive reserves. Entering a gold-buying race now would be an admission that they were right and that the United States is late. Worse, gold markets are deep, liquid, and transparent. Large-scale U.S. buying would immediately be detected, triggering global copycat accumulation and driving prices vertically before the U.S. could secure meaningful quantities. Gold also lacks leverage. It stores value, but it does not power supply chains. It does not control technology. It does not determine industrial capacity. Silver does. Silver is monetary and industrial. It is essential to electronics, energy, transportation, and defense. It is irreplaceable in modern infrastructure. And critically, the dominant silver producers and holders are not U.S. adversaries. Mexico, Peru, Canada, the United States itself. That gave silver a unique dual function in the Fed's analysis. A hard asset hedge against dollar decline. A strategic choke point in industrial supply chains. This is where the decision pivoted. The Jackson Hole Summary states that silver accumulation would allow the U.S. to retain leverage in a post-dollar world economically, industrially, and geopolitically. Once de-dollarization crossed the threshold of inevitability, the Fed no longer had the option of doing nothing. Operation Silver Shield was no longer controversial. It was necessary. The second force that pushed the Federal Reserve into Operation Silver Shield is not ideological, it is not political, it is not theoretical, it is mathematical. The United States is trapped in a debt structure that can no longer be stabilized using traditional monetary tools. As of the Jackson Hole meeting, total U.S. federal debt stands at $36 trillion. That number alone does not capture the danger. The danger is the interest. At current rates, the United States is now paying approximately $1.2 trillion per year just to service the debt. That is more than national defense, more than Medicare, more than any other single federal expenditure. And it is rising automatically without a single new law being passed. Every year, the government runs deficits between $1.50 and $2 trillion. Those deficits are financed with new borrowing. That borrowing increases total debt. That debt increases interest payments. Those interest payments require still more borrowing. The Jackson Hole document refers to this as a closed-loop insolvency spiral. Once interest becomes the fastest-growing budget item, the system enters a phase where time itself becomes the enemy. The Federal Reserve included a briefing from the Congressional Budget Office in the emergency session. The CBO's projection is devastating. By 2029, even under optimistic assumptions where interest rates remain near 4%, interest payments alone exceed total federal tax revenue. In plain language, the United States will not collect enough money to pay the interest on its debt, let alone fund the government. At that point, the country is insolvent. There are only two traditional responses to that reality. Option 1. Print the money. Monetize the debt. Fund interest payments with newly created currency. That path leads to currency collapse and hyperinflation. Option 2. Default. Cut off borrowing. Refuse to pay. That path detonates the global financial system because U.S. Treasuries are the foundation of banking, pensions, insurance, and sovereign reserves worldwide. The Jackson Hole document is explicit. Neither outcome is acceptable under national security criteria. That left the Fed with only one viable alternative: prepare for systemic reset before it becomes unavoidable. The document contains a full section titled Post-Dollar Monetary Architecture. This is not speculation. This is not contingency planning. This is an active framework. The Fed's internal conclusion is that the current dollar system cannot survive the coming decade in its present form. When the reset occurs, whether through crisis, restructuring, or reissuance, the United States must have real assets to anchor credibility. Fiat alone will not be trusted. Treasuries alone will not be sufficient. Digital systems alone will fail. Hard assets are the only universally recognized backstop. And silver occupies a critical position in that architecture. Unlike gold, silver is not merely a store of value. Silver has embedded demand. It is consumed. It is destroyed in use. It must be constantly replaced. That gives it intrinsic utility that persists regardless of monetary regime. The Fed's analysis states that a silver-backed component of a future monetary framework would provide credibility in global settlement, stability in domestic industrial production, leverage over strategic supply chains. In other words, silver is not just a hedge, it is a control mechanism. Accumulating silver now, before a crisis forces the issue, allows the United States to enter the next system with assets instead of desperation. That is the logic. The debt spiral removed the Fed's ability to rely on time, growth, or gradual adjustment. The math closed the door. Operation Silver Shield is not about speculation or price targets. It is about survival. But the debt crisis alone did not force immediate action. What turned planning into urgency, what triggered the emergency meeting, was the third failure. Because while the Fed was running projections, China was already moving. The first crisis made collapse inevitable. The second made delay impossible. But the third crisis is what forced immediate action. This was not theoretical. This was not modeled. This was not projected. This was already happening. According to U.S. intelligence assessments cited directly in the Jackson Hole document, China has been accumulating silver aggressively for at least 18 months. Not through public announcements, not through central bank disclosures, through state-owned enterprises, sovereign wealth funds, and private entities acting as proxies. Quiet, systematic, relentless. The Fed's internal estimate is staggering. China now controls approximately 2.1 billion ounces of silver. That is the equivalent of over 5 years of global mine production. And more importantly, it represents direct leverage over the United States industrial base. Silver is not optional for a modern economy. It is essential for solar panels, advanced electronics, electric vehicles, military and aerospace systems, grid infrastructure, and high-reliability conductors. There is no substitute with comparable conductivity, efficiency, and durability. This is why the Jackson Hole document uses a phrase that should alarm everyone. Silver has become a strategic material. The warning escalated from concern to crisis in December 2025, when China imposed a ban on refined silver exports. That ban remains in effect, and its impact is already being felt. U.S. manufacturers are reporting extended lead times, rising premiums, inconsistent supply, forced inventory, hoarding. The document states plainly that if the export ban persists for 6 months, production slowdowns in key sectors become unavoidable. That includes renewable energy deployment. That includes semiconductor manufacturing. That includes defense procurement. This is not an economic inconvenience. It is a national security vulnerability. The Jackson Hole briefing from the National Security Council frames the scenario in stark terms. If China controls enough silver supply, it can throttle U.S. industrial capacity without firing a shot. This is not new behavior. China did it with rare earth elements in 2010. They are doing it now with gallium and germanium. Silver is simply the next escalation. And unlike rare earths, silver sits at the intersection of finance, energy, and defense. That intersection is why the Fed's response was immediate. The document states, failure to secure domestic and allied silver supply presents unacceptable exposure to industrial disruption under geopolitical stress scenarios. This is the sentence that ends the debate. Once silver is framed as a weapon, accumulation is no longer optional. It becomes defensive infrastructure. That is why the Fed rejected passive market reliance. That is why they rejected price suppression. That is why they rejected paper solutions. They chose physical accumulation. The recommended target, 500 million ounces, was not arbitrary. It represents approximately 6 months of U.S. industrial consumption, enough to buffer supply shocks, enough to neutralize export bans, enough to deny adversaries monopoly power, and critically, enough to reshape global pricing. The Jackson Hole document makes a key point here. Silver markets are thin. Outside of long-term industrial contracts, only about 300 million ounces per year are available to investors and discretionary buyers. Absorbing 500 million ounces in 12 months means consuming more than the entire free float. That cannot happen quietly, and it cannot happen without repricing. This is the moment where policy meets physics. You cannot remove that much metal from circulation without forcing the market to respond. Which brings us to the part the Fed understands better than anyone else: psychology. Once it becomes public knowledge that the United States government is building a strategic silver reserve, behavior changes instantly. Investors front-run. Nations copy. Industrials hoard. Retail panics. That is why the document does not ask if price will rise. It asked how far, and that question leads directly to the number. $267 per ounce. At this point, the story stops being emotional and starts becoming unavoidable. Because once the Federal Reserve commits to removing 500 million ounces of physical silver from circulation, the outcome is no longer a debate. It is arithmetic. The Jackson Hole document devotes an entire section to price impact modeling. Not commentary, not opinion. Formal simulations run by Fed economists using global production, inventory, and demand data. The question they asked was simple. What happens if the United States government becomes a sustained buyer of 500 million ounces of silver over 12 months? They modeled 3 scenarios. Scenario 1. Conservative. This scenario assumes existing holders willingly sell, no panic. No copycat buying, rational, orderly markets under these assumptions. Silver rises sharply, but remains controlled. The modeled equilibrium price, $170 per ounce. Then the economists add a footnote. They describe this scenario as unlikely because it ignores human behavior. Scenario 2. Moderate. This scenario assumes U.S. buying becomes partially visible. Other nations take notice. Sovereign copycat accumulation begins. In this model, countries like Saudi Arabia, Japan, South Korea, and UAE decide they should also hold silver if the United States believes it is strategic. Total sovereign demand increases to approximately 800 million ounces over 12 months. The modeled equilibrium price, $234 per ounce. Again, the Fed flags a problem. This scenario still underestimates psychological spillover. Scenario 3. Aggressive, most probable. This is the scenario the Fed marks as most likely. It assumes public disclosure of U.S. accumulation, retail investment panic, industrial hoarding, sovereign copycat buying, supply chain fear. In this model, silver stops behaving like a commodity and starts behaving like a strategic asset. Total demand reaches 1.2 billion ounces in 12 months. Global mine supply, approximately 850 million ounces. That leaves a deficit of 350 million ounces. The market can only resolve that deficit in one way. Price must rise high enough to force selling from long-term holders, destroy non-essential demand, incentivize maximum production, balance the physical market. The Fed's model calculates that equilibrium at $267 per ounce. This is not a target. This is not a guess. This is the clearing price where supply and demand finally meet. And here's the most important part. The Fed explicitly states that this price is not temporary. Once silver is repriced to strategic asset status, it does not revert. Why? Because the fundamentals do not revert. Industrial demand continues to grow. Mine supply cannot expand quickly. Strategic reserves remove metal permanently from circulation. The Fed understands this, which is why they designed 2 distinct accumulation phases. Phase 1, stealth, January-March. This is where we are now. The Fed is buying quietly through the Treasury's Exchange Stabilization Fund, intermediaries, long-term forward contracts with buyers. The goal is simple. Secure as much metal as possible before price discovery begins. This phase allows the Fed to lock in supply at sub-$100 levels and negotiate multi-year contracts before competition appears. Phase 2. Public, April-December. Once disclosure becomes unavoidable through reporting laws, congressional briefings, or investigative journalism, the strategy shifts. At that point, price no longer matters, speed matters, quantity matters. The Fed becomes a buyer of last resort. They will outbid everyone, because the alternative, losing industrial security, is unacceptable. The document acknowledges that the initial $21 billion budget is symbolic. Actual costs will be far higher. And the Fed accepts that, because cost is irrelevant when compared to systemic failure. This is why the price trajectory is front-loaded. The cheapest silver will exist before the story breaks. Once the market understands what is happening, $267 is not shocking. It is inevitable. The only remaining question is timing. And that brings us to the final section. Now we get to what matters most: timing. Because intelligence without timing is useless. According to the Jackson Hole document, Operation Silver Shield unfolds in 2 phases, and we are already inside the first. Phase 1. Stealth accumulation. January-March 2026. Right now, the Federal Reserve, through the Treasury's Exchange Stabilization Fund and intermediaries, is quietly buying silver. No announcements, no headlines, just contracts. They are offering multi-year forward purchase agreements to miners in the U.S., Mexico, Canada, and Peru, locking in future production before the market realizes what's happening. At the same time, they are absorbing spot supply in fragmented lots to avoid detection. By the end of January, 10 to 15 million ounces removed. Prices drift higher, not explosive. Markets still asleep. February is when strain appears. Refineries tighten. Wholesale inventory thins. Premiums rise. Silver creeps toward $120, $130. Still, no confirmation, but insiders know something is wrong. March, the break. This is the inflection point. A leak, a journalist, a confirmation by silence. Federal Reserve quietly building strategic silver reserve. That single sentence detonates the market. Retail panics. Dealers sell out. Industrials hoard. Sovereigns take notice. Silver gaps violently from the $130s into the $170s. By late March, price $185. Fed accumulation, approximately 150 million ounces. Psychology, permanently altered. This is where paper fails. The paper trap. ETFs and futures depend on deliverable metal. When physical disappears, creation units stop, redemptions get suspended. Paper detaches from reality. Physical silver trades at triple digits. Paper silver lags or collapses. You cannot convert promises into metal once the metal is gone. That is the trap. Phase 2. Public accumulation. April-December 2026. The Fed confirms the program. Numbers aren't disclosed, but the market already knows. Other nations follow. Supply evaporates. Silver is no longer a commodity. It is a strategic asset. Prices move fast. April, $200 plus mid-year. $240 plus year-end. $267. That number is not a spike. It is the reset. After $267, this is where most people are wrong. Silver does not crash after the Fed finishes buying, because 500 million ounces are permanently removed. Industrial demand still exceeds supply. Governments do not sell strategic reserves. $267 becomes the floor, not the ceiling. The window. You are hearing this in January 2026. Before headlines. Before panic. Before scarcity. January is opportunity. February is expensive. March is chaos. April is too late. This is not advice. It is a battlefield update. The Fed has admitted defeat. Hard assets are back. Silver has been chosen. Operation Silver Shield is live. And the repricing has already begun.